Hello everyone, and welcome, and thank you for joining us today. I'm Tom Shoup. I'm Editor-in-Chief at Government Executive Media Group, and it's my pleasure to welcome you to today's Viewcast, Getting Ready for Retirement. Before we welcome our speaker, today I have a few logistical things to cover. We want you to be an active part of our conversation, so we encourage you to submit questions. On your viewing platform, you can do that using the Questions tab at the top of the console. Feel free also to write in questions using Twitter via the hashtag #ReadyForRetirement. Later in the program, we'll take a look at some of those questions, along with some that have already been submitted in advance of today's Viewcast. And after the event, after we're done with our conversation, please stay tuned for a special presentation from our underwriter, Long-Term Care Partners. And the last thing is we'll be sending an email later this week with a link to the recorded version of the Viewcast. So let's get started by meeting our guest for the day. Tammy Flanagan has been providing retirement assistance to federal employees since 1985, when she first began her work as a benefits specialist at the FBI at the age of 13.
That's right. I was going to say, it makes me sound older.
She's been Government Executive's retirement planning columnist since 2006 now.
10 years. This is our 10th anniversary.
Yes. She's also the Senior Benefits Director at the National Institute of Transition Planning and offers individual retirement and pre-retirement counseling services. And you can find her online at tammyflanagan.com. So welcome, Tammy. Thanks again for doing this.
Thank you.
Feel like it's been a while since we've had this conversation, and it's always fun. Let's start with the big picture. How is the federal retirement picture changing, especially with many more people now in federal employees' retirement system as opposed to civil service retirement system?
That's right, Tom. It's amazing that we had this 30-year cycle because FERS started essentially when Congress changed the law to make federal employees now pay into Social Security, which started in 1984. So it's now been over 30 years, about 32 years. So we've seen almost this 30-year cycle of all the CSRS employees starting to retire, and we now have less than 10% of the workforce left under CSRS. And now all the FERS employees are coming on to the retirement rolls. And so it's changing the whole face of retirement because we're starting to see people retire with less service. You know, a lot of FERS employees will come into federal service mid-career. We're certainly starting to see a lot more people relying on their Thrift savings plan to help supplement their retirement benefits, where with the old system that wasn't necessarily a big part of their retirement. So it is changing, and we're starting to see a lot different questions when it comes to even Social Security.
Yeah. From a planning perspective, are FERS employees, is your sense they're getting more comfortable with the three-legged stool with the pension and the Social Security and their Thrift savings plan?
Well, I think you might even remember this 10 years ago whenever we started writing the column about the FERS and CSRS kind of debate about which one's better or just how are they different, because I always wanted to point out to people who had to make a decision, do you want to make them different, or is one better than the other, or which one should I be in? And a lot of people would say, well, don't ever try to say that FERS is better than CSRS or even anywhere near as good as it, because they all thought that civil service was, the best thing since sliced bread. But now we're into it 10 years later, and we are seeing people with very significant TSP accounts, and we're starting to see that FERS basic benefit for a full career of 30 years of service. And when you add the FERS benefit, the TSP, and the Social Security, you're getting essentially the same amount of retirement income, but you're getting more flexibility because you don't necessarily have to turn all three pieces on at the same time. Some people will choose to delay Social Security. Some people will choose to not take money out of their TSP as soon as they retire. And so you can turn those things on and off where you couldn't do that with the old system. So I think if the one word about FERS is probably an advantage is it's more flexible.
And with that flexibility comes more responsibility on the part of the participant to manage their retirement.
And a lot more to have to know. You have to be more educated because you can make some decisions that can affect the rest of your life, not knowing how investments work or how to manage your money or how Social Security will kind of tie into your FERS benefits. So yeah, there's a lot more to know, that's for sure.
One of the differences you mentioned, of course, is Social Security, and we've had some changes there recently. So I'm going to put you on the spot because it's kind of technical, but how have the rules for claiming Social Security changed this year?
Well, I guess to simplify things, if you're not yet 62, if you haven't turned 62, then you're not going to get to do any of the old rules. So you won't even notice the change because it's not going to be available. But for someone who turned 62 prior to 2016, that person can still decide to claim what we call a restricted application, where you can restrict your application for Social Security to your spouse's work record and then delay your own benefit to let it grow and become more generous. So that's only available now for people who have already reached age 62. Then the other thing about Social Security that changed was something that just happened last month in April, where if you take your Social Security at age 66 at your full benefit age, you could choose to delay it so that your spouse can claim a benefit on your work record and then take yours later. You can no longer do that. So now when you file for Social Security benefits, you have to claim the benefit. You can't delay it so that your spouse can apply. So I think the main thing that really changed about Social Security was a little less flexibility to allow people to maybe strategize how they take their benefits, especially for a married couple. That's where we're really seeing some of the changes.
And this was the result of congressional action last fall,
It was.
Right?
Yeah, there was a law that changed kind of suddenly. I wasn't aware, a lot of people weren't aware that was coming. It kind of got tucked in there. And it wasn't a major change.
Are you saying Congress makes backroom deals without giving people a lot of notice?
Little sneaky change there, but it wasn't a major overhaul of Social Security. Like I think a lot of us are waiting for when are they going to change the age or when are they going to change the tax rate, and none of those major significant Social Security changes have happened yet. There's a lot of potential for that change, we know, because Social Security funding is something that everybody's had an eye on for many years. And I think we will eventually see some significant changes in the future, but those haven't happened yet.
So regardless of whether these new provisions apply to you, everybody has to think about claiming Social Security at some point. What are the factors they should take into consideration as they go through that process? Yeah,
it seems to be these days that Social Security is becoming more of a factor in retirement planning than it was before. And I think part of that has to do with the fact that we have so many people now saving for retirement. You know, the whole idea of the TSP has only been around since 1987. 401k plans started not long before the TSP. So back in the days of our parents' generation, you know, when they retired, they did have to take Social Security or they couldn't retire. But today's generation, we have the option to say, well, why don't we wait for Social Security to get a little bit more generous, and in the meantime, we can take money out of our 401k or our TSP account. Or in fact, we also see people who retire but go back to work part-time so they can delay Social Security. So it's a matter of trying to figure out when's the best time to turn it on, realizing that we're going to die on the same date no matter when we started to take it. So if we live a really long time, if we have a lot of longevity, it might make sense to delay Social Security till we're a little bit older. But if you die early, you may not get any benefit if you never have turned it on. So it's a matter of, are you still working? Do you need the money? And how long are you going to live? If you could answer those three questions, you would know exactly when to claim your benefit.
If you can answer those three questions, you can see into the future very clearly.
So you can see how financial planning is not an exact science, right?
Yes. The older I get, the more I learn that. This is a question that comes up, I know, in the column on a fairly regular basis, that it seems like people are not entirely clear on. What's the full retirement age under Social Security?
The full retirement age, and again, it varies if you ask about Social Security, if you're asking about the FERS or CSRS system. So we talk about different ages for different benefits. But for Social Security, the full retirement age is the age you can claim your unreduced benefit. And that's somewhere between 65 and 67, depending on when you were born. So everybody knows about those Social Security statements that you either have received in the mail, or you can go online to socialsecurity.gov and get your Social Security report. It's going to tell you at your full benefit age or your full retirement age, this is your retirement. But if you claim it younger, as young as age 62, you can still get a benefit. It's just going to be reduced. Get a small check for a long time or a bigger check for a shorter time.
Let's talk a little bit about one of the other key elements under FERS, the Thrift savings plan. Many people are starting to grow pretty substantial nest eggs in the TSP. Are you seeing changes in the way people invest in the TSP and withdrawal strategies?
I think overall, and I think the TSP has been seeing this as well, that the participation rate has steadily grown, but it's now kind of leveled off. That we're seeing close to 87%, I think the last time I looked at numbers, 87% of the federal workforce contributes to the TSP. So it's a very strong participation rate. And I think a lot of that's driven by the fact that government employees get matching contributions. So if you don't put a dime in your TSP account, you still get 1% from your employer. But if you put in up to 3%, you get 3% matching plus the 1% automatic. And if you put 4 and 5% in, then you get the full 5% match. So we are starting to see, even at starting gate for new employees being hired, many of them are catching on to the fact that they want to maximize that matching funds. And a lot of times I meet people who every time they get a promotion, they increase the amount they're putting in their thrift. And before long, they're really up there at the 10 to 15% participation rate. So they're really preparing well. And I think part of that's driven by the fact that they feel that FERS is inferior to CSRS and they have to save for retirement. And when they reach 56 or 62 years old, they're pleasantly surprised that they have both the basic benefit and the thrift to really support them in retirement. So it's turned out to be a nice blend of benefits.
Yeah. I wanted to ask you about an issue that I know you've written and said has come up frequently and causes a lot of confusion among employees, and that's service credit deposits.
Yeah.
Can you explain sort of simply what the issue is there and why it's so important?
Yeah, this is when everybody turns off their computer, they're going to talk about service credit, how boring. But it's actually, creditable service is something that I think as employees, we don't think that much about because we think that our agency's taking care of it for us. You know, they maintain our personnel records, they know when we started, they know when we leave, but it really can become a pretty significant issue at retirement time. Because we forget that maybe when we were first hired, we started as a summer hire during college. And maybe we didn't have retirement coverage, but yet we were a federal employee. Or maybe throughout our career, we went from full-time to part-time service, which can also affect the value of your retirement benefit. So thinking about your work schedule, thinking about your history of federal service, where did you start? Where did you go from there? Did you have a break in service? Did you ever take a refund? All of those little nuances in your career can have an impact on how much your retirement is going to be. And if it doesn't come up to meet you until the time you retire, it comes as a surprise that maybe we're missing records or maybe there's money missing from the retirement fund. So when we talk about mid-career planning for an employee who still has 15 or 20 years left in their career, one of the big things I like to emphasize is review your service history, ask questions of your HR office to make sure they have the records of that summer job or your military time. Find out if you have to pay for any of that service in order to get the credit. So there's a lot of issues that employees can be proactive on to help make the whole retirement process go smoother down the road. And
this is, speaking of being proactive, it's one of the reasons why it's important to keep copies of your own records.
I think so, yes. I'm not a big clutter bug, but I do like to keep records of that federal service. Federal employees have access to their official personnel folders now electronically. They have the EOPF. And you can, in many cases, not all agencies, depending on where you work, but in many cases you can download that onto a flash drive or a CD where you can keep a copy of it yourself, especially if you're going into retirement, because once you're off the payroll, you have very limited access to those records, and it's nice to take those with you.
So we have something of a rarity coming later this year, and that's an open season for federal employees group life insurance.
Right.
And you've written about this a little bit, and in fact, just to tease, there'll be a column about it appearing this afternoon. But what's going on there, and what do employees need to be aware of?
Yeah, as most employees know, life insurance in the government, you're enrolled in it when you're first hired. You have an option to enroll in additional coverage. And the only time after that you really think about it is when there's a life event. If you get married, divorced, if you have children, that's when your needs for life insurance typically change, and you have options at those times to increase your coverage to take on those new responsibilities. But every once in a while, the government opens it up as an open enrollment. And this is one of those years. So in September of 2016, there will be a month-long open enrollment. But here's the catch. So you can increase your coverage, you don't have to pass a physical, you don't have to have a life event, but your coverage won't take effect until next October of 2017. So you have to hang around, don't die before then, because your coverage wouldn't be effective. And the other thing is, if you want to carry that increased amount of life insurance into retirement, you'd have to work another 5 years after 2017. Because just like with health insurance, there's a 5-year test saying that you have to be enrolled in that level of coverage to take that additional coverage into retirement. But for younger employees, it's a good opportunity. If you want to increase your coverage, it's coming up later this year.
How generally does FEGLI compare to life insurance you could get in the private market?
Yeah, it's a lot of times you'll look at the rates of FEGLI, especially as you get older, because every 5 years optional FEGLI gets more expensive. And if you compare that to just across the board private sector term life insurance rates, you might feel that FEGLI is very expensive. And if you're in good health and you're otherwise insurable, you might be right. You might be able to go out and get much better rates on the outside market. But what's nice about FEGLI is that it covers all federal employees regardless of their health. So for an employee who might have a condition like heart disease or diabetes, and they might not be able to get those preferred rates for life insurance, they can get FEGLI regardless of that, especially during an open season. So it covers all federal employees regardless of their health. It allows you to increase the coverage when you have a life event without regard to your health. Every time you get a pay increase, FEGLI goes up with your salary, so you're constantly getting increasing amounts of life insurance when you get pay adjustments. And I guess another thing we don't really like to think about, but it's true, is that FEGLI pays no matter how you die. So whether it's an act of terrorism, whether it's suicide, whatever causes your death, FEGLI pays those claims. The only time there's an exception is if your beneficiary intentionally caused your death. And I kind of like that clause. But yeah, so FEGLI is priced fairly for what it is. But if you're really looking for a better rate, you might be able to go out and find it. You should shop around.
In general terms, people like to throw around specific numbers relative to how much money they'll need in retirement. So whether it's 60% or 80% of pre-retirement income, where do you come down on that?
Yeah, I think it's more important really to think about how much you spend. Because I meet people who save like crazy, they have no debt, they're living on a fraction of what they really earn. So those folks can retire on a much smaller percentage of income than, say, someone who's living on 80% of their salary. So really think in terms of how much are you going to spend in retirement. It's probably not a whole lot different than what you spend now. Now you might be downsizing, maybe you're going to sell the house, move someplace less expensive, or maybe the kids have finally been launched and you no longer have to pay for college or weddings or all the things we have to spend on children. But I will tell you, you still spend on your kids even once they're out of the house, because then they start having grandchildren for you. But you have to really think in terms of realistically how much money you're really going to be spending, which probably is not much different than you do now. But also keep in mind that some of the things we pay for as employees, you no longer have to pay for in retirement. For instance, the contribution to FERS or CSRS, the contributions you're making to the Thrift savings plan, the Social Security taxes, both Medicare and FICA end once you stop working. So those reduced amount of withholdings from your income are certainly going to mean you can live on less than your gross pay. So what we really want to look at is the net. Compare your net income as an employee to what your net retirement income is going to be from all sources. And some people like to discount the thrift. They think, well, here's what I get from FERS and here's what I get from Social Security, and I can't live on that. I says, well, you weren't supposed to. You have the thrift. That's your third stream of income, but no one wants to spend it. We've spent so many years saving it, it's hard to part with that and start to use it.
And you have to decide how much of it you want to withdraw and how much you want to leave in so that it continues to grow in value.
Right, and it could run out. And I think that's the biggest fear people have, because you have this specific amount of money you've saved for retirement. Now how do you make it last 30 years? Or maybe it has to last 40 years, or who knows? So I think that's a big dilemma now that people are facing with these significant balances in TSP, trying to figure out which is the best option to withdraw, because you have as many choices of what to do with the thrift savings plan when you retire as you had to decide how to invest it, how much to save during your career. So you have to now think in terms of using the money rather than accumulating the money. So it's a whole different mindset, and it's difficult for many people to figure out and wrap their mind around what to do with that.
Yeah. In addition to being financially ready for retirement, people need to be mentally prepared. What questions should they be asking themselves as they think about what their life is going to be like in retirement?
It is a big transition. I think for many federal employees, it's not about the money. I mean, I meet people every day who have 38 years, 42 years of federal service, and they're still coming to work every day, very happily coming to work in many cases. So I think it's about the fact that what's my life going to look like after I retire? I'm not going to see these people that I come to know as family over all these years. I'm going to be at home all the time, and I'm going to have to structure my own time. So I really have to think about, how am I going to spend my day? How am I going to deal with the fact that I have a whole new social circle once I retire? And for those of us who are married, what's that going to change in the dynamic of our spouse? You know, now I have 24 hours a day that we're going to be together that we never were before. So I think the mental preparation for retirement can be just as equally important as the financial preparation.
Great.
But it's kind of hard to predict.
Yeah.
We've never done it before.
I want to get to some of the audience questions now, and we had one come in on the TSP, since we were just talking about that.
Perfect.
Let's take that one. Regarding TSP withdrawal, is it possible to withdraw the interest gained and preserve the principal? And does all the TSP need to be withdrawn in a given time frame?
Okay. Yeah, so the TSP right now, for the withdrawal choices, you have two options when you leave federal service when it comes to your thrift. You can take a one-time partial withdrawal where you just take a chunk of it out, and you may want to roll it into an IRA so you have more freedom to use it or reinvest it. And then you have the option to take a full withdrawal. Now when you take a full withdrawal from the TSP, that means you're taking perhaps a monthly payment with some of it, maybe take some of it and buy an annuity with it, and maybe with the rest of it you take it out as a lump sum to maybe reinvest it in your IRA. But the way it works currently is when you make those distribution payments from the thrift, especially when you're doing a monthly distribution, you can't say, I just want to take out the interest. You can't say, I just want to take money from the G fund and leave the C and the F fund alone. So everything's coming out pro rata. So if you're invested 40% G and 60% C, it's going to come out 40% from the G fund, 60% from C. The TSP is aware that that's not as flexible as most employees would like to have. So there's some proposals on the slate that they want to make that more flexible in time to come. So that they're getting together, to my knowledge, a package of proposals that Congress will have to have some blessing over and make some changes to make things more flexible. So I wouldn't encourage anybody to rush out and move everything out of the TSP until that takes place, because I think you'll find things are going to become a little bit more freed up and flexible as time goes on.
The TSP is a sort of ever-evolving thing,
Sure.
right? Like there are constantly incremental changes being made.
Absolutely, yeah. And the nice thing about the thrift plan, as I've watched it since it started back in 1987, the thrift plan has evolved in a way that's made it more flexible, more usable, more options for employees that they had before. They started out very tight, and I think for a reason, until they got into the swing of things and started building that balance of account balance. You know, we used to have open seasons. We used to have only 3 funds, the G, F, and the C. Now we have 5 funds. Now we have life cycle funds. We may end up having a mutual fund window in the TSP at some point in the future. So it's evolved and it's grown at the same time, very, very safely and very very good, in a good way.
Yeah, and many more people involved in it than there used to be, and, and growing with the addition of military service members.
There was 4.7 million TSP participants and about $500 billion in the account. So it's it's the world's largest employer-sponsored savings plan.
And compared to private sector plans, the administrative fees are generally pretty low.
Very low. Oh yes, absolutely very low, because number one, there's no commissions, no fees. Number two, a lot of the administrative expenses due to the sheer volume of the accounts. So it's spread across so many more employees to cover the computers and the staff it takes to run the TSP. There's even some source of revenue from forfeited contributions. So when a federal employee leaves federal service within 3 years, that 1% the agency put in their account stays in the fund to help pay and offset administrative costs. So that's another source of revenue.
I bet agencies would like to get that money back.
I know, well.
Here's a question on Medicare,
Yes.
always a
Big
popular topic. And this person says, my husband is older than me, already retired, not a federal employee, and is currently signed up for Medicare Part A only. I carry him on my FEHBP plan, which I will carry into retirement. But I'm planning to retire in the coming year, a couple of years before I turn 65. Should we be exploring parts B, C, and D for him when I retire, or can we wait until I turn 65?
Okay, well, for those of you who haven't really started to think about Medicare yet, the original Medicare that started back in 1965 is Part A and B. Part A of Medicare is what you see out of your paycheck is that payroll tax. Sometimes it's called the hospital insurance tax or Medicare Part A. So once we reach age 65, or if we became disabled even sooner, we are automatically enrolled in Part A if we're getting Social Security benefits. So that's kind of a no-brainer because there's no premium for it. It kind of dovetails with your federal health insurance or with TRICARE if you're military, and that's really not the question. What most people wonder about is Part B. Now, Part B of Medicare is outpatient care, your doctor visits, lab work, physical therapy, outpatient care at a hospital, which is the majority of our health care as we get older. So do we need this coverage knowing that our federal health plan covers outpatient care as well? So that's always the big dilemma because Medicare Part B, for most people today, it's $121 a month per person. And when you multiply that by a husband and wife, that's $240 a month on top of the premium for your federal health insurance. And the thing is, your federal health plans will still cover you even if you don't take Part B. So now you see why there's such a dilemma, because employees don't know what to do. Should I enroll and pay that extra premium for coverage that I already have? Or should I take my chances and just keep my federal health insurance and not enroll in Part B? So I think the best thing to do is evaluate your health plan that you're in by looking at how it works with Medicare B. You'll find that many of the fee-for-service plans will waive your deductible, your copay, your co-insurance, so that you don't get any expenses out of pocket other than those premiums. So if you have that arrangement with your health plan, that's could be a good deal, especially in your later years. Now, in the case of the employee who asked the question, she's still employed carrying the health insurance for her husband. So she's buying him some time because he doesn't have to pick up Part B until she retires and her health insurance starts to come out of her retirement benefit. Part B has a late enrollment penalty generally if you wait past age 65 to enroll, but the exception is if you're covered by current employment health insurance, you can delay that enrollment. So we could spend an hour on Medicare, but I understand for employees it is a big decision because it's a big expense, and it's something that when you're healthy you don't know that you're ever going to need it. But I do recommend considering it in most cases.
Do some FEHBP plans, do they incentivize you to sign up for Part B in certain ways?
Yes, many of the plans will do that. Many of the plans kind of cater to the needs of people who are older and retired where others don't. Like for instance, some of the HMOs don't waive their copays. They don't really provide much of an incentive at all to enroll in Part B. So you have to look at that plan to see, is that the right plan I should be in now versus maybe this plan over here that has a lower premium waives all my deductibles and copayments when Medicare's primary. And so there are some plans in the FEHB program that are going to be a better fit with Medicare than others. If you have 5 plans that all waive deductibles and copayments and all have a pretty good prescription benefit, then you might want to pick the least expensive of those 5 because you're going to have pretty much the same coverage. So it does pay to really study those plans once you're getting close to 65. But also think of your other family members' needs as well, because you might have a younger spouse, you might have children at home, so don't leave them out. Don't pick a plan that works well with Medicare if everybody else is 45.
Yeah. Yeah. Here's a simple question from a viewer, but on a subject that comes up fairly frequently. Who makes the final decision on your retirement computation, your agency or OPM?
Now, that's a good question because the only counseling you can get for retirement prior to retirement is through your agency. So most agencies, upon request, will provide you with a retirement estimate. And it always says estimate at the top with a warning in fine print that says this is only an estimate. OPM has the final authority over these numbers. So once you're separated and go into retirement, then OPM gets the claim and they process it and they recalculate and make sure everything's credited properly, make sure that your former spouse gets whatever they're supposed to get. So OPM does have the final say in the numbers. The problem is that OPM doesn't finalize the claim in many cases until about 2 months after you've left. So you really want to have a lot of faith and confidence in those estimates you get, because that's all you have to go on before you retire. So ask a lot of questions, make sure you understand what that estimate's saying.
And OPM itself has had its share of struggles in processing and getting the time it takes to get a final verdict on your retirement down.
Yeah, unfortunately, retirement is still a paper process. It's not been electronically mandated yet. So because you have to fill out a paper retirement application, it goes to your agency. The agency has to mail it to OPM, and somebody has to sit and go through the papers. That in itself is a tedious process that does take time. And
at some point they have to go in that cave in Pennsylvania and look up your records, right?
As the Washington Post dubbed the sinkhole of bureaucracy a couple of years back. But yeah, they've made great strides in trying to make it more efficient of a process and get things moving. And the majority of claims get processed within 60 days, which does sound like a long time, but really that's not that long, because during that time you're getting your last paycheck, you're getting your lump sum annual leave payment, and OPM will send you an interim check every month that they delay the process. So it's not like you're going to be left with nothing until it's finished. But there are a few that can take months and sometimes over a year if there's problems. So it's in your best interest to do as much as you can prior to retirement to make sure everything goes smoothly. Work with your agency on that.
Great. Here's a question on a subject that people may not want to think too much about, but that you've written about a little bit earlier this year, and that's divorce. Mm-hmm. I plan on retirement in the next 3 years. I have an ex-wife, and our divorce papers say nothing about retirement, hers or mine. I'm not after hers, and she agreed not to go after mine. Is this okay?
That's perfect. Yeah, that would be the way to do it, because if you have a retirement, your spouse has a retirement, and you don't want your own retirement to be dictated by when your spouse retires. You know, just the opposite of that question. I had a couple one time where in her divorce agreement it said that her ex-husband gets half of her retirement, but then in his divorce decree it says she gets half of his. So neither one of them can retire comfortably until the other ex-spouse retires. And so they're having a standoff, and they're both in their late 70s, and neither one wants to retire because that means the other spouse gets half of their retirement. So that's a good situation. The question you had where it's silent means that I keep my retirement, you keep yours, I'll see you later, and we'll go our separate ways. So if you have a financially dependent spouse who didn't work outside the home, then that's oftentimes when you'll see a portion of the retirement benefit go to the former spouse, and even the survivor benefit as well. So it all depends on what happens with the settlement of the divorce. So really pay attention to what it says in the divorce decree, because that generally will tell you what, if anything, your ex-spouse is going to get from the benefit. But it can be a big matter in the retirement plans.
Yeah. Mm-hmm. Here's a FERS-related question. How does the FERS supplement work?
Or what is the FERS supplement? Yes, a lot of people don't know what it is. And some people think it's a Social Security supplement because it really does kind of take the place of Social Security. So the FERS supplement is paid to just a portion of the people who retire under FERS. You're entitled to the supplement if you retire with an immediate unreduced retirement and you're younger than 62. So this would be people who are around 56 with 30 years of service, or even people who are age 60 where the service requirement's only 20 years. So from that age of retirement until they turn 62, OPM will include this extra payment, this extra money in your retirement benefit until you reach the age of 62. And it's really meant to bridge the time between your federal retirement under FERS and when you qualify for Social Security. But it's only based on your civilian service under FERS. So it's probably going to be a little less than what your actual Social Security benefit would be. Plus it doesn't get a cost of living adjustment. It stays the same throughout the time you receive it. And for some people, once they retire, if they go back to work, it's tested for outside earnings so you can lose it. But it's really meant for someone who wants to fully retire at a younger age, and that brings in that piece that's missing from Social Security until you reach the age to qualify for it.
This is also one of those things that you hear from time to time that Congress might be taking a look at. Do you think that's a safe benefit?
Yeah, well, I don't know if any benefits are safe anymore, because if you look at the private sector, pension benefits have pretty much disappeared for new hires into private industry. And who knows if that's going to ever happen to the federal employees, where we lose that basic pension benefit under FERS and just have the thrift savings plan. That luckily is not on the table. But yes, from time to time we've heard Congress propose to get rid of that FERS supplement. So far it's still there. So let's hope it stays for those who are counting on it.
Here's a question about Social Security. If I leave federal service at 62 and live off my pension and savings while deferring Social Security application until age 70, how exactly will that affect my benefits? I understand the formula provides for a substantial increase in benefits the longer I wait to claim, but will 8 years of zero Social Security taxable earnings pull my lifetime average down so far that waiting is no longer worth it?
No, I mean, your lifetime average is whatever the high 35 years is, wherever that ends. So if you work till you're 66 instead of 62, it's going to be a little higher average if you continue to work full time. So that's a whole different question. But delaying Social Security from 62 to 70 could be as much as $1,000 a month difference in your monthly benefit, even if you never worked a day past age 62. So it really boils down to that first question where we talked about how long you're going to live. Because if you wait till 70 to claim it and you do get $1,000 a month more, but what if you die at 72? It wasn't worth waiting 8 years to get it. So in many cases, people are still taking Social Security when they stop working because it just makes sense. Because otherwise you are going to have to withdraw money from your retirement savings that could pass on to another generation or that could last longer and help you live comfortably throughout your retirement. So if you're going to do those kinds of calculations, you might want to hire a financial professional unless you're really good at projecting those numbers, because there's a lot of moving parts to that question.
Great. Here's a question from somebody who's picked up on the TSP discussion. Mm-hmm. If you have a TSP loan, which will be paid back before retirement, does that still allow you to take a one-time partial withdrawal after you retire?
Yes. Yes, if you have borrowed from your TSP account prior to retirement, you can borrow multiple times. You pay back one loan, you can take out another loan. In fact, you can have 2 loans outstanding at any given time. So taking a TSP loan during your career does not get in the way of having that one-time partial distribution. However, if you're working in the federal government past age 59 and a half, you can take an age-based in-service withdrawal, which is not a loan. It's where you're going to take a partial payment of your TSP account prior to retirement. So if you've done that age-based withdrawal, after retirement you'll not be able to do the one-time partial distribution because you already did it. So I think they were getting confused between the loan and that in-service withdrawal. It's 2 different things.
Great. Here's a question about somebody who's contemplating leaving government for a second career. And they say, I'm far from retirement age, their age is 33, but was wondering what the FERS rule was in regards to retirement once I hit 20 years of service. I currently have 8 years. I'll have 20 years when I'm 45. Does this mean that I can leave government service at 45 and claim my full FERS benefit once I hit 59 and a half? If I was enrolled in FEHBP at the time I left service, would I be eligible for the health insurance benefit through a FERS retirement once I hit 59 and a half?
Yeah, so I think that's a lot there in that question. Yeah. But the basic question I think is, when I leave federal service before I'm eligible for retirement, right, what can I get later? Like what still is there for me? So the vesting rule for FERS is 5 years of service. So those of you who have 5 years of federal civilian service, you're vested. That means if you resign, you'll have a deferred retirement payable as early as 56 years old. So you'll have something to show for the work that you did based on your service and your salary when you left. Now, as far as health insurance and life insurance, the requirements there are that you have to have an immediate retirement, which means you have to work until you're old enough to retire. So your health benefits and life insurance, you would forfeit those. You'd have temporary coverage or the ability to convert your life insurance to a separate policy, but you wouldn't be able to reinstate those benefits unless you came back and got rehired. Now your thrift savings plan, remember I said there's only 3-year vesting for the 1%? Everything else belongs to you the day it goes in there. So your TSP account, even if you don't stay in government service for 5 years, that money still is yours and you can continue to add to it with moving into a 401k at your next employer or an IRA if you're self-employed, whatever. So your retirement savings accumulate no matter where you work. And of course, Social Security is the same Social Security for federal employees as it is for private sector. So the main thing you're giving up when you leave federal service is that accumulation in your FERS basic benefit and the very valuable benefit of continuation of health and life insurance. And those are two things that are near and dear to most federal retirees' hearts. So those are very important benefits that you want to really give good thought to before you leave federal service too much early.
Yeah, because you can't leave and then decades later come back and claim that health insurance.
Well, it's easy to leave. It's not that hard to come back. Or not that
you
easy
could
to
theoretically come back and work 5 years, and then those benefits
you wouldn't even have
kick
to
in.
work 5 years. You just have to come back. Most people, when they have a break in service like that, where they had some federal service and then they went out into private sector, when and if they do come back to federal service, they usually try to come back for 3 years. They want to establish a new high 3 at current pay rates rather than the one when they left 20 years ago. But your 5 years of health benefits and life insurance can latch on to your past appointment. So the time you were gone doesn't count against you. So last 5 years can be those 3 years from the past and 2 years when you come back. So that's still 5 years.
As long as you're taking an immediate retirement.
That's right.
Here's a question which for all the years I've been reading and editing your column, I still don't entirely understand. Can you please explain what CSRS offset is?
Yeah. We do have more and more people these days under offset because civil service offset would be a coverage typically for someone who was prior federal employee, had over 5 years of government service, maybe back in the 70s or 80s and left. Now they've come back and gotten rehired and they have to pay into Social Security because they've been gone for more than a year. So these employees are still technically CSRS, but they have full Social Security coverage, which is offsetting or reducing what they pay into civil service. Now when they retire, they're still going to retire under civil service rules. But once they hit age 62 and retired, that civil service benefit gets reduced or offset by the Social Security that they earned from the time they came back to federal service. So it's a kind of a hybrid of Social Security mixed with civil service. Some people have called it the best of both worlds because you're increasing your Social Security benefit yet still preserving that higher calculation for CSRS. The downside on the offset plan is the fact that number one, you're not getting matching on your Thrift, so you're not a FERS employee. And number two, you have to kind of be aware of that reduction that's going to happen when you hit 62. Because if you choose not to claim Social Security, you're still going to take the reduction in your civil service, and you might have to wait, or you might desire to wait a few more years to claim Social Security. So, but technically, for all intents and purposes, if you're CSRS offset, you're still civil service, but you have that Social Security coverage as well, which could come in handy.
Yeah. Here's a question that we got about survivor annuities. Would it make sense to provide a partial survivor benefit that would only cover the cost of health insurance, making my monthly annuity more, and invest the difference in the cost of a full survivor benefit versus a partial benefit, assuming there are other methods of covering living expenses?
Didn't say when he's going to die, did he?
He says, for my spouse, if I die first. He didn't specify when that would be.
If his wife dies first, then it's okay. But if she outlives him, that's a big risk, not to him, but to her. Because a surviving spouse benefit is going to replace half of your retirement under FERS. So if your retirement, let's say, is $40,000 a year, that survivor benefit's $20,000 a year to the surviving spouse. That gets a cost of living adjustment. So you'd have to invest and be invested a long time to try to come up with the amount that would be equivalent to the value of that, not knowing how long you're going to live, how long your spouse is going to outlive you, and what the rate of inflation is going to be over your lifetime. Now, if you time it right, where your spouse only outlives you by 6 months, I think that strategy would work. But what if your spouse outlives you by 25 years? Not going to be adequate. So think of a survivor benefit as life insurance, which is what it is. And it's life insurance that pays for the life of your surviving spouse, cost of living adjustments, and it's automatically paid out. Plus it protects the health benefits, as he pointed out. So I really worry when someone who has a financially dependent spouse wants to do something different than that survivor benefit, because it's very hard to put a value on it not knowing the answers to those questions of how long are you both going to live and what's inflation going to do over your lifetimes.
Great. Here's a question about what I would characterize as the single most popular thing you write about every year.
I think I
and
know
that is
what
the
it
best
is.
date to retire.
Yeah.
So this person says, I'm considering retirement in January 2017. I plan on not using annual leave during 2016 in order to maximize the cash payout for unused leave. So I've tentatively selected January 5th, 2017. What is the best date to actually leave service in order to maximize my cash payout?
Not January 5th. Okay. And she's close, or he's close, whoever that is. Well, the whole point of that question, I think, was that somebody wants to retire at a time when they can maximize their lump sum payment for unused annual leave. So what a lot of employees have done as they plan for retirement is they'll carry over, because a lot of you are in the 8-hour accrual. You have over 15 years of federal service, so you accrue a lot of leave in the later years of your career. So many employees will carry over that maximum 240 hours of leave carryover. And then knowing that they're going to retire that next year, they'll save up 8 hours, 8 hours, 8 hours. And so by the end of the year, they've saved up an additional 200 hours on top of the 240. So you'll have somebody like in her case or his case have 440 hours of unused annual leave. And you start to multiply that by an hourly pay rate of $40, $50, $60 an hour, that's a significant lump sum payment. However, the reason why I said don't retire January 5th is because if you're under FERS, if you retire January 5th, you won't get a retirement check for the month of January. You'll forfeit that check. So I would say go out December 31st at the latest, so that way you'll accumulate all but the last accrual of leave. You'll get the payment in the next year for tax purposes, and you will get the monthly retirement benefit for January. So I'd say go out December 31st if you're trying to strategize the lump sum leave payment if you're FERS. CSRS employees could retire up to January 3rd and still get a January check. There's this 3-day grace period that the old system has, but FERS doesn't have. So if it's all about the leave, the end of the year is a good time to go.
Great. And people should know that
thousands of people retire every month.
Yes. But that later this year, you'll be writing your annual column about this, and there'll be a calendar in there, and it's a very handy way of looking at the year and figuring out, because there are other times during the year.
Absolutely, yeah. There's all different reasons why people retire different times of the year. Some has to do with taxes, some has to do with the weather, some has to do with a second career or maybe a spouse's retirement. So there's a lot of factors that you have to weigh out when you're deciding when is it time to make that final separation from my federal career. It's a big move.
Yeah. Well, we could go on all afternoon with this, and I think we'd probably have plenty of questions. But we're coming to the end of our allotted time. So thank you again so much for your insights and for the services that you provide to federal employees. And as always, you can read Tammy's work on govexec.com every week in our retirement planning column. And thank you for everybody for tuning in today and for participating and sending in your questions. I'm sorry we couldn't get to all of them. Our next segment will feature our own Tim Hartman, CEO of Government Executive Media Group, in conversation with today's underwriter, Long-Term Care Partners. So please stay tuned for that, which will be coming up in just a minute or so. Thanks.
Welcome back. Thank you again for joining us, and thanks to Tom and Tammy for the earlier discussion about retirement planning, which is one of our most popular topics all the time. My name is Tim Hartman. I'm the CEO of Government Executive Media Group. I'm here with Joan Melanson, who's the Director of Program Promotion for Long-Term Care Partners. To tell you a little bit about Joan, she's dedicated herself to the outreach and educational components of promoting the federal long-term care insurance program and the program's growth overall. She works very closely with federal agencies and affinity organizations, including active employees, annuitants, retiree organizations, members of the services, to really advocate and educate the people who are interested in long-term care and people who are looking to plan their retirement about all the benefits of the program. You're really an evangelist in many ways for retirement planning in the program.
Well, it's been 14 years now since the inception of the program. Where does the time go?
That's amazing. And so let's just get right to it. First of all, thank you for being here today. It's great to see you again.
It's a pleasure to be here in sunny DC. We've had a rain for about 2 weeks here.
That's right. And but we've had a glorious retirement planning discussion already. To continue that, retirement planning is on the top of so many people's minds. There's such a large portion of the federal workforce is eligible to retire right now. And recently, we actually conducted a survey and research on retirement readiness of the federal management ranks. And in that survey, we found that 40% of the respondents said that they felt like they were ready for retirement, and 60% said that they were not ready. And I'm just curious, given the engagement that you have with federal employees who are planning to retire, does that number surprise you? That seems like a large number.
It is a large number, and actually it doesn't surprise me at all, Tim. We think about retirement for a long time. I mean, even young people say, I'm going to be retiring early and so on and so forth. But it's a big life change. And the one theme that came out when Tammy and Tom were talking was that the big variable is how long are you going to live. So when you're trying to make a plan for the future that is kind of evasive, it can move around. You also have a different perspective about retirement as you go through it. It's no wonder to me. I view it as a journey, not a destination. It's not a place that we're trying to get to. You don't get a GPS that will help you navigate to this place, but you try to move through to what you think you've been working for many years of your lives. Some of us started working when we were 20, and if you're retiring at 60, that's a long period of time. So I guess I'm not surprised. I'm facing that myself. And it's a big life change.
Right, and it's one of those things where if you feel totally confident that you've got your plan in order, then maybe you're overconfident in what you're actually planning. So the respondents look forward to retirement and they having leisure time and spending time with family. But I'm sure you see this all the time. There are many who haven't taken the actions to prepare. Is that common that you see? Why do you think that is?
I think it's because you don't quite know what the actions are. I mean, think about it. As I just mentioned, if you've been working for 40 plus years, you've had very much of a routine every day. My day is that, I work 8-9 hours a day. I commute an hour each way. I'm sure many of you have that kind. That's already, you're using up, if my math is correct, 11 hours a day. That's planned. It's scheduled. Now you're thinking about a time in your life where it's very unstructured. And it's easy for me to say, yes, I'm going to spend time traveling. I'm going to spend time with the kids, the grandkids, and so forth. All the things that I've wanted to do. But it's a big chunk of change that all of a sudden you're filling that time. And I think there are a lot of emotions associated with it. It's the excitement of not having to commit those 11 hours a day to something every single day where I'm going to work and I'm dealing with those issues and I'm commuting and so forth. But at the same time, it's all not structured, and I'm excited. I have some fear about it. How am I going to do that? I'm anticipating it. I think it's just there are a lot of factors in there, and I can speak from experience getting there. Is what's it going to look like, and can I really find enough to do to fill all of my time after so many years of a very routine life?
Tom and Tammy touched on this a little bit. So much of what Tammy has written about for over the years has been about financial planning, but she also touches on the mental aspect of it, and we touched upon it today. Can you comment a little bit on the dual preparedness that's needed for retirement between the mental planning and the financial planning?
Well, it's interesting. Tammy does talk a lot about that, and we talk about long-term care as being the insurance that could protect your nest egg. But there is a big focus on it, and we're seeing it more and more. Will you have enough money to retire? And it boils down to, well, how long you're going to live. It's the very first thing that a financial planner will say to you. And it's very different if you say, I'm going to live to be 85 versus 90 versus 100. It's very difficult to figure that out. I just saw a Wall Street Journal article that said something like, should I assume that I'll live until I'm 100? And in reality, if you look at 1980 to 2010, you had 1.9 million people that were 80 and over. And it's expected over the next 40 years, the next 4 decades, to quadruple. And we know every year there are more and more people living to be over 100. So when I mentioned before, why am I surprised that people don't feel prepared? Well, think of it. You don't know how long you're going to live, and all you hear financial planners said use 90 before. Now maybe it's 95. Now maybe it's 100. That makes a very, very big difference in your financial plan. Those numbers make a very, very big difference. On the mental part of that, though, I think now we're reading more and more about the mental piece of it. And there was another Wall Street Journal article, I happened to see 2 of them this past week. It's retiring after 65 may help people live longer. And there's a lot more about taking care of yourself and how you'll live longer. But remember, people didn't live that long before. And so you retired at 62. But now if you're going to live to 90 or 100, that's a lot of years to fill. And I think the point of this article about if you work longer, you'll live longer, working is really a surrogate for all the things that keep people going. When you work, you have a mission in your life. My mom was in her 80s and she took care of small kids. And I said, Mom, why are you doing that? She said, you know, Joan, it gives me a reason for getting up every day. I feel valued. I feel useful. So I think work gives you feel valued, you feel useful, you have socialization. I mean, there are people around. Now, they may not all be your best friends, but you do see people every day. You're engaged in something. These are surrogates for keeping people alive and moving. And I think if you don't have a plan like that, then, and people can, and Tammy mentioned that too, you have no place to go. You're staring at each other. We're married, and 24/7 we're staring at each other, and that's what we're doing. And we had so much more in our lives before. So I think that's really an issue. You've got not only the financial, but you also have that mental for many more years than we ever anticipated.
So just with the time we have left, just have one final question. Half of the respondents cited changes in personal health as a possible disruptor to their retirement plans. What suggestions do you have for respondents to deal with the health issue in particular?
Yes, I mean, that's 49% of the people said that's a big issue, health concerns, because you can do all the things that I just talked about, but if you don't deal with the personal health issue, that's going to be a problem. And when I say deal with it, whether it's medical or particularly long-term care, have a plan in advance. And what we say to people is educate yourself. Talk to your spouse, your family members. What are my wishes? Don't have them second guess. Educate yourself. We do a lot of retirement seminars where we talk about long-term care as a piece of retirement planning. Put together your will, put together your power of attorney, your health care proxy. Get all those things together before the crisis. You don't want to do doing these things in the middle of the crisis happening. You want to do it in advance. So have a plan, educate yourself. There's so much more of a focus on personal responsibility. No one's going to help you figure out your retirement. You need to take charge of it on your own. And that would be my words of wisdom.
Well, thank you, Joan. I think we're going to have to wrap up, but I want to thank you and Long-Term
Thank you.
Care Partners for underwriting this and so much of what we do in the retirement planning space. We really appreciate it. I want to thank Tammy and Tom for their thriving discussion about retirement planning that was done entirely without notes on Tammy's part, which is one of the most impressive things that I have seen. If you would like to view this event again or share the archive with your colleagues, the recorded viewcast will be available within the week. We'll be sending an email later this week with the link to the recorded viewcast, so keep an eye out for that and feel free to pass it along. Once again, I want to thank everybody for joining us and thank our viewers in particular. We'll see you soon.